Have you ever wondered why money so often feels like a burden instead of a tool? Why every boom seems to be followed by a crash, and why debt, whether national or personal, always seems to grow faster than our ability to pay it back? To answer that, we need to look back, not just decades, but thousands of years. A 4 millennia chain of debt. From the first Mesopotamian clay tablets to today's central banks, humanity's money story has largely been a debt story. Ancient empires recorded IOUs long before coins were common. Rome expanded its reach through bonds and collateralized loans. Medieval merchants perfected promissory notes and bills of exchange. By 1694, the Bank of England was issuing paper money backed by government debt, a pattern repeated worldwide. Even after the gold standard collapsed in 1971, we kept the same foundation. Money is created when someone goes into debt. Central banks issue currency, commercial banks multiply it through lending, and interest payments flow upward. It's a system designed to keep growing or break. The structural trap. Why does this matter today? Because a debt-based system demands perpetual expansion. If the economy stops growing, defaults ripple through the financial sector. Those with collateral, large corporations, wealthy investors, can borrow cheaply and compound their advantage. Those without it pay higher rates, struggle to keep up, and often fall further behind. In other words, the rules reward existing capital and punish vulnerability. It's a game where the house always wins, and the house is built on credit. A radical question. So here's the big question. Must money always be born from debt? For 4,000 years the answer appeared to be yes. Until recently. Enter Pi Network. Pi Network approaches money from a different angle. Instead of issuing currency as a certificate of debt, it treats money as a certificate of contribution. Anyone with a smartphone can participate. You don't borrow to create Pi, you contribute. Your mining rewards come from proving engagement and securing the network, not from pledging collateral or signing a loan. This isn't just another cryptocurrency tweak. It's the first large-scale attempt to sever the link between money creation and debt altogether. When the project's founders, Dr. Nicholas Kokalis and Dr. Chungyao Fan, called Pi's launch a historic moment, they weren't exaggerating. They were describing a break in a 4,000-year chain. Why this matters for the future. If no debt is required to issue currency, the system doesn't collapse when credit dries up. Liquidity flows from participation, not leverage. Staking and contribution balance the money supply with real community activity. That means Pi's foundation isn't perpetual growth, it's perpetual cooperation. Imagine a monetary infrastructure that could last centuries or even millennia, because it doesn't depend on the next generation borrowing more than the last. That's the promise of contribution-based finance. A new monetary civilization? Of course, questions remain. Will Pi achieve global scale? Can contribution-based money coexist with debt-backed fiat systems, or will it slowly replace them? History tells us financial revolutions rarely happen overnight. But history also shows that once a more sustainable model proves itself, old systems eventually give way. For the first time, humanity can experiment with truly debt-free money. Whether Pi becomes the dominant currency or simply sparks new designs, it signals the opening page of a civilization-level transformation. So, after 4,000 years of borrowing from the future to pay for the present, we finally face a different possibility. Here's the final question. If money no longer needs to be born from debt, what new kinds of societies, and futures, might we dare to create?